Well, today was a dark day for financial markets. The Fed came out in the form of both Bullard and Powell to, I guess, give the good news about what direction the Fed is going to be moving in the intermediate future, and also really the short-term, very near future. But unfortunately, the old stock market and the old bond market were not too happy about what the Fed had to say. So you had Bullard talking about how the Fed is behind the curve, about how they got to fight inflation, and how he wouldn't rule out a 75 basis point rate hike, which would, from where we are now at 25 basis points, that would bring the Fed funds rate all the way up to 1%, which is nothing, but it's a lot when you look at the last 10 years. It's a lot when you consider that even at its reduced rate, its reduced level that it's at now, the NASDAQ has still almost doubled since the lows of 2020. And so there's a lot of gains in the stock market that can be wiped out by the Fed here. If we look at the bond market, it's not exactly a prettier story. The yield curve is pretty ugly. It is positively sloping for the first part out to like 5 years, but then after that, it kind of just gets bumpy. Everything, I believe, from the 5-year on out is 2.9 something percent. And looking at the history of the 10-year, which is kind of your, that's kind of your middle of the road benchmark treasury yield, as far as, just the one that people compare over time, the 10-year is at its highest point since, you guessed it, November of 2018. That time when I talk about how Powell almost ended the business cycle and, did his job as the Fed chairman, ended, popped the last bubble, but then he backtracked. He pulled out and he couldn't do it. He gave up. He was a coward. And he has extended the business cycle now by 4 years. Well, now here we are 4 years later, and the 10-year yield is back to where it was all the way back then. Back when the balance sheet runoff was on autopilot. Remember that? And yes, while Bullard is not Powell, Powell isn't sounding much more dovish compared to Bullard. Powell seems pretty set on a 50 basis point hike at the next Fed meeting. I don't believe there's been a 50 basis point rate hike since the 2008 financial crisis. So this would be a pretty big deal if it happens. And Powell is a guy who doesn't like to surprise the markets. Certainly doesn't like to surprise them to the hawkish side. So he is telegraphing this because I think at this point it is his intention. He may still chicken out. If stocks really puke between now and the next meeting, he might say, okay, well, we'll only do a 25 basis point rate hike, in which case you'll have a massive relief rally and probably all new all-time highs because, oh my gosh, look, the Fed was dovish. And maybe I'm exaggerating a little bit. Maybe you won't have new all-time highs. Now you look at mortgage rates, it's not a pretty story either. We're at 5.25%, depending on where you check. That ain't great. Mortgage rates were in the 3s not too long ago. In fact, I think I even talked to somebody who was able, it wasn't easy, but they were able to finagle a mortgage in the 2s. Yet now we are sitting at 5.25%. Now 3%, I don't think that is a red line for bonds. That is not the end of the world if we see the 10-year at 3% yield. But that's playing with fire. That is the upper limit of what we have seen in the past few years. And when yields get too high, in this kind of an environment, when everything is being sold, when this is not, a pivot from stocks into bonds, but rather a mass exodus out of financial assets in general, I can't see this ending well. The only hope for financial markets at this point is a Fed flip-flop, and a Fed flip-flop that works. It's never guaranteed that a Fed flip-flop is going to have the desired effect, even if it happens. It has happened, every time that the market has wanted it in the past, and, Super Powell has been able to come in and save the day each time. But, for those of us who have been following Powell since he first began his tenure as Fed chairman, we noticed that each one of his knight in shining armor moments, each time his armor gets a little duller. His sword doesn't have the same edge that it once did. It takes a little more work to slay those dragons. Sometimes the dragon isn't even totally slain. It's just sort of annoyed into leaving and going to raid another castle. The Fed no longer has the power to bail out the entire planet like they did in 2008. They don't have the power to control financial markets, with a snap of the fingers or a flick of the pen. Financial markets are more vulnerable now to rising interest rates than ever, and the Fed is less empowered to try and rescue financial markets, to deploy the net, under this tightrope and catch them if they fall, than they have been, at any point in the past few years, probably in the last decade, maybe ever, because as you see, zero low bound, it's a real thing. And so as once the Fed got down to 0% interest rates, they couldn't cut anymore. The only way that they could cut interest rates was by raising them first. And so they can't cut lower than they raised them, which has been the Fed's pattern, going all the way back to the peak of interest rates under Paul Volcker. Ever since then, every time the Fed cuts rates, let's say there's a little bit of inflation, so the Fed has to raise rates to rein that in. They never raise rates back to where they were before. And then when they end up cutting rates after that, they cut them deeper. So you see how this is? We've been taking a sort of a bumpy ride, zigzagging up and down, but on a downward trend for 40 years. And considering that the Fed is not done hiking rates yet, it's unclear where we're going to see interest rates go. Are we going to start to see, could 3% be the peak for treasuries? Could 3% be where the market recognizes, okay, the Fed's going to have to cut? They're going to have to go back to full QE, even though the Fed is still expanding its balance sheet, which is kind of confusing. The Fed is supposedly engaging in quantitative tightening, yet the balance sheet is expanding. I haven't had time to really look into that. I'm sure there's an explanation for that, which is sufficiently devious, but I don't have time to get into that. I want to focus on the rest of this. But what always happens during these cycles is that at some point, before stocks bottom, you see bonds start to rebound, pricing in the Fed's incoming rate cuts, because that's what Powell always does. But in order for Powell to reverse at this point and start cutting rates again, which again, he's only raised once. Remember this, we're at 0.25%, 25 basis points, 1/4 of 1%. And even if he hiked 50 basis points, we'd be at 3/4 of 1%. Yet, Treasury yields are looking awful high. If Treasury yields get much higher, things will start to break. 4% would be extreme. 5% would be catastrophic. Yields have, I think, almost doubled in just the last few months, and this quarter, which isn't hard to do when you're starting from near the zero lower bound. In real terms, of course, Treasury yields are deeply negative, and so it is unclear to what extent the inflation premium will be pushing up Treasury yields. Economics 101 would dictate that it's going to have some positive effect, but it's not necessarily clear that we will see that actually manifest in the price. In other words, if you want to think of it from like a logical perspective, I'm not necessarily sure if this is going to be the case, but if you want to think of it from an Econ 101 perspective, you could say if yields stay where they are, or start to go down while inflation remains high or gets higher, you could say that, okay, yeah, the inflation premium is increasing, but it's just that the market demand is just increased so much that rates are becoming more negative in real terms. And I'm sure there's always many ways you can trying to read Treasury. The Treasury yield curve is like reading tea leaves or wishbones. But my first instinct if we get to that point and I start to see yields move in the other direction, my instinct would be that is front-running the Fed's rate cuts. And a lot of people like to say, well, the Fed doesn't control Treasury yields. It's like, well, yeah, but if the Fed funds rate was 20%, do you think that the 10-year yield would be 2.9%? If they're so confident that the Fed has no influence over Treasury yields, then why not just raise the Fed funds rate to 20%? What could it hurt, right? I mean, we've only seen a direct correlation in the direction of the Fed funds rate and, over the long term, the Fed funds rate and the 10-year Treasury yield, all the Treasury yields, for the last 40 years. So, gee, why would I think that these two things are connected? But anyway, this idea that Powell could start, or that the Fed could, reverse course anytime in the next few months is sort of predicated on them abandoning their goal of reducing inflation, which of course has no chance of being accomplished if they don't deflate the asset bubble. So, who knows? I mean, it's very hard for me to take someone like Jerome Powell seriously because he's not a serious person. He's a fundamentally dishonest snake. But, if he is serious, and I know I've repeated myself ad nauseum about this, I have to always give this caveat. Is Powell serious? Is he not serious? That's not something, if this guy truly was a public servant, that I would have to do. The Fed, as much as Powell, prides himself on trying to be transparent and always forecasting, and whatever he's going to do and telegraph it, so that Wall Street knows how to invest accordingly to, so that they can, flow with the Fed. He makes his statements as opaque and just word salady as possible, so that you can't really understand. He'll tell you at the end of the day, okay, I think we should hike rates, or I think we should cut rates, or I think we should add QE, whatever. He'll say what the end result thing is. He will telegraph that, but you have no real, there's no reasoning behind it. There's no logic to anything coming out of the Fed. So if what he is telling us, and again, this is the hard thing, I can't judge, I can't put myself in his shoes because there is no thoughts that are communicated. There's only statements about, what they plan on doing. As of now, the Fed plans on fighting inflation. In order to do that, rates are going to have to keep going up. I think probably 1.5%, 1.25% is what we'd have to see to really take down the asset markets. And on top of that, we would have to have the Fed then let it happen and not fight it. Don't fight against the crash that you provoke. The crash itself is our ticket out of here. The average home price in America is like $375,000 now. If there's an ounce of truth to anything that Powell says, the Fed shouldn't stop until they bring that number down to maybe 150 or 200. I'm old enough to remember when you could buy a house for less than $100,000. I knew people who did it. But regardless of, how far you think the Fed is going to take this, I think that it's clear that things are still going to get worse from here. Now, the housing market obviously is still accelerating. It has not stopped yet. And the housing market will take a lot more time than the stock market. It's not going to be like it was before, in the '08 crisis where housing went first. Before, it was the housing market that brought down the stock market. In this case, the stock and bond market will help bring down the housing market. And so I definitely see things getting worse from here. That doesn't mean there won't be relief rallies and things like this. What is it? The slope of hope, they call it. As financial markets march on down. If we're going to get a bottom, it's going to have to come from a Fed pivot. And even that, again, it's unclear if that will be sufficient, because the Fed doesn't have much room to work with at this point. But that is their only hope. And if that doesn't work, which eventually one day it won't work, eventually the Fed will not be able to come right in on their white horse and save the day for Wall Street. When that day comes, it's game over. Then we have a financial reset, and everything changes. The sooner that day comes, the better, because then we won't have to play this silly game anymore. No normal person benefits from this. No normal person is going to, obsessively track all this crap, just so that they can make sure that they're invested to move in whatever direction Jerome is moving on that given day. And so, while we have been in a lull, I shouldn't even say a lull, in just a downturn period now, really since the end of last year, I think that we're getting into the serious range. Obviously, the NASDAQ is well off its highs. I don't know if it's exactly 20% or more than 20%. I'm not keeping track of exactly where these things are anymore. It's really only rates that concern me directly. I mean, stocks will follow. Rates have always been what mattered. Stocks are not an indicator of much of anything except for the wealth effect. But the stocks themselves are manipulated, and then stocks will manipulate other prices. And for those of you unaware, I didn't explain this in this video, but I've talked about it ad nauseum in the past. What the Fed is trying to do here is they have, through the wealth effect, inflated an asset bubble in general, which have made people feel rich, go out and spend lots of money, which is part of the reason why we have this big inflation problem, because, one, people want to go out and spend that money, they feel like they can, and two, they have the money to spend. It's been injected into the economy through the massive deficit spending by the federal government over the last couple of years that has led to a huge injection of new dollars into the economy. And then, of course, when it comes to assets themselves, people's assets are being inflated, and then they can sell those, let's say, and buy a retirement home. In order for inflation to cease and for all of this to go back to normal, you got to pop that bubble. And we're nowhere near there yet. We need like a 50% decline in stocks, at least. And hopefully a comparable decline in housing prices, but preferably more. I would like to see housing prices go as low as possible. Remember back in 2008, the housing bubble popped, but we never got to where housing was cheap. We just got to where housing was back at the long-term average. Prices returned to normal in the last housing crash. They didn't really ever get cheap. So, on that note, I think I'll end it here for today.